Welcome back to our monthly series with Greg McGeorge from JMI Wealth. Greg has over 35 years of experience in financial markets, both here and in London, and JMI Wealth has over 6 billion of investments. Now this month, Greg is going to be talking about the return of meme stocks, a growing trend towards more speculative investments. And remember, if you do want to chat more with Greg about your investments or the market in general, you can find him and his details at jmiwealth.co.nz. Thank you. So Greg, we're talking about meme stocks again. I saw recently in the headlines that apparently Roaring Kitty out of nowhere is back at it.
Yeah, that's exactly right. After going into hibernation for a few years, out of nowhere, Roaring Kitty is at it again with his meme stock. So it's probably worth explaining a little bit what meme stocks are and who, of course, Roaring Kitty is. So meme stocks simply refer to shares in a company that go viral when retail investors start posting on social media platforms, in particular the likes of Reddit and YouTube, and they create a bit of a frenzy and push the price of the shares up. And these companies, they experience massive price hikes and incredible falls as well. And it's all driven by online hype rather than the actual business fundamentals. And Roaring Kitty, whose real name is Keith Gill, he gained a cult-like following in January 2021 for his influential YouTube and Reddit posts, encouraging people to buy shares in a company called GameStop, which is a bricks and mortar video game retailer. So on these forums, everyone encouraged each other to go and buy these shares. And these retail investors, they pushed the share price of GameStop up from something like $17 at the start of January 2021 to as high as $500 before the end of the month. It was incredible. And one of the key reasons why the retail investors were piling into GameStop initially, and several other out-of-favor businesses, was to show that they could foot it with and outsmart the large institutional investors and hedge funds. These large institutional and professional hedge funds, they like to dub the retail investors as dumb and dumb money, while of course calling themselves smart. Anyway, the smart investors were actually betting against the likes of GameStop, believing their share price would drop. And it sort of makes sense because professional investors' view of these companies is that these mall domiciled businesses were heading the way of the dinosaurs and they were going to go bust. So why not sell them short and when they go bust, make money? Of course, on the other side of the trade were these retail investors stirring up a frenzy, buying frenzy, pushing the price the other way as high as they could in the hope of giving these professional smart investors a bloodied nose. And that's exactly what they ended up doing. By pushing the price up so much, the retail investors were able to inflict huge losses on these professional institutional investors. In fact, there's one hedge fund called Melvin Capital that was short GameStop. They actually ended up getting a bailout to the tune of nearly $3 billion from their previous employer, although Melvin Capital did eventually shut down their fund. So the whole meme craze was a real rude awakening to these large professional investors who believed they controlled the markets, they were the smart people, they had the knowledge and the skill required to make money. Actually, in the end, these smart investors actually started building models that would scan these Reddit forums to see what these retail investors were looking to buy next to try and get ahead of them. So it was quite interesting. So that was early 2021, that was all happening. And Roaring Kitty had gone quiet. Well, suddenly he popped up again in the news. And he was posting some very cryptic posts on his Reddit and YouTube forums. Didn't really say anything, but retail investors took it to mean, let's go out and buy some more GameStop shares. So the frenzy started again. And he subsequently posted a screenshot of his GameStop position, and it had a value of something like 180 million US dollars. So of course, what did everyone do? They went out and started buying GameStop shares again and pushed the price of GameStop up even more. So suddenly his 180 was going up and he was making even more money just from a simple post like that.
Well, I don't want to sound too defamatory on this one, but it does sound like that could be arguably manipulation potentially from Roaring Kitty.
He does seem to be buying GameStop shares and posting online about it, knowing all too well that people will rush out and buy the shares and push up the price even further. But on the other hand, manipulation requires some sort of deceptive intent, and his online posts aren't lies. He's telling the truth. There was a US Senate investigation into the whole meme stock craze in 2021. It made several comments about regulation and how the consequences of using social media to encourage others to buy and sell. But there were no real changes made. In fact, actually, the only change that did come out of it was a recent change that came into effect where the settlement of shares was changed from being trade date +2 to trade date +1. So that actual change was all to do with the meme stock and that US Senate investigation. But really, that was the only thing that came out of it. And at the end of the day, should it be illegal to post in a public and very online open forum about a company that you like and encourage others to buy? I mean, it might not be a good look if you buy the shares, post online, push the price up and sell the next day. But that's not what he's been doing. He's been holding them. So is he really doing anything wrong? And there are plenty of professional investors that make public statements about companies they own in the hope of pushing the price up in their favour. And there's an interesting company called Hindenburg Research. So they're a short seller. So what they do is they investigate.
Named after the airship, are they?
Well, it is actually about trying to find companies that are perhaps fraudulent and are going bust and are going to crash in flames.
Yeah. Great.
So that's their strategy. Yeah. They do forensic accounting on companies they think are acting fraudulently. When they find them, they sell the shares short. They make their research public knowledge in the hope that it will push the share price down. So they hope to make more money by publishing their share price. I mean, that's no different really to what Roaring Kitty's doing.
So Greg, it seems like it's not just meme stocks, is it? You're actually seeing more of a general trend towards way more speculative investing from dumb money, as you call it.
Yeah, exactly. It seems to be popping up everywhere, and that's something I wanted to discuss. You're absolutely right. There seems to be a far more general trend for retail investors going into more speculative investments and taking on this additional risk. So a good example is, as well as the meme stock craze we're just talking about coming back, there's also been a huge jump in the amount of money going into what's called penny stocks in the US. So penny stocks, I mean, they're not the same as meme stocks, but let's say they rhyme. It's people willing to put fundamentals aside purely to chase higher returns. So these penny stocks, they typically trade, as the name suggests, for less than $1, pennies, and they have some very similar characteristics. So low market capitalization, so very, very small companies, limited liquidity, so not many buyers and sellers, and massive volatility. So you see share prices just going up and down. So in the last month, in the month of May, 7 of the top 10 most traded equities in the US by number of shares bought and sold, not by dollar value, were penny stocks. And none of these companies are actually profitable. So the huge volume in so many of these little-known stocks suggests a renewed appetite among retail investors for cheap names in which they believe that they can just simply make a lot of money very, very quickly. And when markets get frothy, that speculative froth often spills over into the penny stock market. So these type of stocks can make or lose you a ton of money very quickly. But that's the thing. That seems to be the appeal at the moment. Retail investors just have this real speculative urge that they just can't seem to get enough of it.
So, Greg, that's fascinating. Okay, so we've Roaring Kitty, Hindenburg, right? What other trends are you seeing now?
Well, even the more traditional conservative investor seems to be looking to ramp up risk. There's a growing trend amongst fund managers for these what's called a concentrated exchange traded fund, or sometimes referred to as high conviction funds. So high conviction funds, they aren't new, but they've traditionally been the realm of managed funds. But now you're seeing a lot of them appearing on exchange-traded funds, on stock exchanges. So they're becoming highly accessible for your retail investor. So with an exchange-traded fund, as the name suggests, you can buy and sell into it in exactly the same way you can a share on a company. So now they're highly accessible, and they just seem to be popping up anywhere. So by investing in a high conviction fund, you only have a very small number of companies. So the reason for this, managers are looking to significantly outperform the index. So with these funds, you have reduced diversification. So when you reduce diversification, you increase the chances of getting higher returns, but of course you increase the chances of getting higher losses. So just in the last year alone, there's been 88 new exchange-traded funds opened in the US, which are high conviction funds. So these funds have 50 or less stocks in them, and that compares to a dozen or so 10 years ago. But you have to be very, very careful about these high conviction funds. So they're not all created equal. When you're going down the route of highly concentrated, few number of shares, it's incredibly important to understand who the people are running them, what research talent have they got, who are the fund managers, what's their history. These guys need to be the very best when you're looking at high conviction funds. And a recent example, there's recently launched 25 new exchange-traded funds that are actually going to combine two of the current trends on Wall Street, which is leveraged exposure and option selling covered calls. And it's been somewhat euphemistically called a yield booster.
Do you have a favourite?
Well, yeah, my favourite trend at the moment is something called zero DTEs, and nothing speaks to the speculative urge more than these zero DTEs. So it's 0 days till expiry. So they're options that expire on the same day. They give the option, these contracts give you the option to buy or sell something at a predetermined price. They are very cheap, highly leveraged, and typically involve a huge amount of risk and reward, and of course, total loss. So because they have so little time to expire, the option price movement can be extreme due to its sensitivity to the rate of change in the underlying price of the security that the option is on. So for example, say we have company ABC, which has a share price of $100. You buy one of these zero DTE options to purchase one share in that company. And let's say you buy that option with a strike price of $100. So you're buying it at the current market it's trading. And you pay $1 for that option. If that share price moves from $100 to $101, it's a 1% change. Big deal. Now, depending how sensitive that option you own is, though, that $1 that it cost you suddenly could go to $1.25, $1.50, or even higher. So that's like 25, 50%, even higher gain in your option for a 1% move in the underlying share. I mean, these things, you're literally investing for returns over a matter of minutes. It's about as speculative as you can get. And the option traders I worked with in London, these guys were considered to be the smartest guys in the room because they understood things like the delta, which is the rate of change the options compared to the underlying security, gamma, which is the rate the delta changes, theta, which is the time decay, vega, which is to do with volatility. And I just wonder how many of these retail investors have a clue how theta will be, time decay will be destroying the value of these options because they're so close to expiry. None of them. It just seems like product. That seems to be the trend I'm seeing. Just these incredible new products being launched in the market. It just all seems to have gone rather mad.
So, Greg, what's driving it?
Well, for starters, it's certainly a lot easier and a lot cheaper for retail investors to gain access to markets, which is a great thing. But unfortunately, some investors view the markets as a get-rich-quick opportunity, which of course it isn't. And retail investors are increasingly being drawn into financial markets through the introduction of new products, as we've discussed, these new ETFs, and also the gamification of trading platforms. So these new products are often marketed with promises of high returns and tailored risk profiles, and they're there to appeal to investors seeking sophisticated investment strategies without the need for deep financial knowledge. And at the same time, these trading apps and platforms are employing gamification-like techniques such as interactive graphics and rewards to hook the investors. Also, a big thing happening now is what's called social trading features, such as copy trading. They're gaining huge popularity amongst the novice retail traders.
So, copy trading, what's that?
Yeah, you're going to love this. So some platforms, trading platforms, I kid you not, have leaderboards where they rank the top traders. So what you can do is you can choose to follow a trader and say, okay, well, this person aligns perhaps with my risk profile, or this trader is actually really successful and has got huge returns, and actually allocate some of your money to follow that trader. So when that trader puts on a trade, it is automatically replicated for you. So you have no idea who this person is, what their abilities are, but you're just saying, okay, I'll just follow them. And all these things, help make investing feeling more engaging and accessible. And while it is making it easier to access the markets, it also raises some concerns around the speculative behaviour and there's insufficient, risk awareness amongst these inexperienced investors. It's a great move. It's great more and more people are taking an interest in financial markets, but I'm not so sure there is a corresponding understanding and risk awareness of the products that they're entering into.
Thank you for watching or listening to this podcast. I hope that you have enjoyed it, and so please do like and subscribe. Now, this is a hot topic of meme stocks and GameStop, and you may be aware that we have done a few other videos on this just recently. So please do go look at the library of Sidekick TV to find other videos relating to this topic. Thank you.